Hi, this is Gloria, and I'm going to be talking to you about a couple different things that are going on with our market in April of 2022. So hang on. We're going to be looking at the impact of rising mortgage rates on the housing market. We're going to be talking about the spring market update. And we're going to be talking about some other things that may be of interest. So here we go. So let's start off with the impact of rising mortgage rates on the housing market. You know, a lot of people are seeing mortgage rates rising, and they're asking the question, are home prices going to fall? What's going to happen to sales? There's a lot of big questions out there and a lot of uncertainty. I've pulled together a historical data to show you what's happened historically when mortgage rates were rising and what happened in those environments. I'm going to start off with a look at how mortgage rates have been rising this year. Well, it's no surprise, right? Mortgage rates are on the rise. This is the data from Freddie Mac, and it goes back to the very beginning of the year. What you can see over there on the left is that mortgage rates started out at 3.11% for the average of a 30-year fixed at the beginning of the year. And they have just steadily climbed since then. They're actually up 5%. Our data that we had reported says 4.76, but it's really 5%. And the data that Freddie Mac presents here is actually a look back at the previous week. At the end of March, the average 30-year fixed was 4.67. People are asking why. I think this next quote will really help. It says, this is from Freddie Mac as well. Quote, mortgage rates are likely to continue to move higher through the balance of 2022, although the pace of rate increases is likely to moderate. Much of the increase in rates is early in 2022 is an anticipation of what will happen after this year, especially with the Federal Reserve interest rate policy. So what does that mean? You know, rates are projected to continue rising. That's what the experts are saying. That's what I've been sharing with you all along, but likely at a more moderate pace. The Fed has risen their rate and mortgage rates tend to follow that. And that takes a little bit of uncertainty out of the market. Some of these rate increases have been priced because experts now know what is projected to happen. Now, as I mentioned a moment ago, the big question people are asking is what's going to happen to home prices as mortgage rates rise? A lot of people think that when rates go up, prices go down. Well, I want to share with you what the data says about this. So what you're looking at here is the impact of rising rates on home prices. When mortgage rates rose by more than a percentage point, this goes all the way back to October of 1993, so almost 30 years. It shows that there is an average of about 8% home price appreciation as mortgage rates are rising by more than a percentage point. Overall, what we can see is that rising rates have not had a negative impact on home prices. A lot of people have more questions about what's going to happen with sales. So let's take a look at this addition to the same data and add some home sales in the same period of time, going all the way back to 1993. Now, what we can see here is that there is an average of a decrease of 11% in home sales as prices were rising. We know as rates rise, that tends to sometimes reduce buyer activity. It prices some people out of the market. But we have a fundamentally very different housing market than we had in some of these environments. So let's take a look at the first line, where October 93 to December of 94, mortgage rates increased by 2.38% to the final rate of 9.2%. So let's be super clear that we're not looking at a 2.5% increase in the mortgage rates right now, okay? So calm down. Rates are not projected, according to experts, to get to 9.2 or 9.2 mortgage rates. This is a very different environment than in the past. Let's factor that out. So we can look at the rising mortgage rate environments that are closer to what we're seeing today, which is 1 to 1.5% increase. So let's look at the same data where you can see overall. There's a little bit of orange, there's a little bit of black, meaning home sales as mortgage rates are rising in these environments. Really negligible impact. So maybe down by 2% impact on home sales as mortgage rates are rising, okay? And of course, the outlier of 2005, 2006 was led up to the housing crisis, and home sales dropped by 14%. What we can see here is when you factor this data out, we start to see that rising mortgage rates don't have a huge impact on homes. Why is that? I think the big things that we can look at is what's available for sale. We have to look at the inventory component, because today what we are seeing is drastically low inventory. Inventory today is lower than it was in January 2021. And keep in mind that was historically low then. So very, very low inventory. It's a huge deficit. And when the inventory is that low, we want to think what's projected to happen moving forward. Home prices are projected to continue to rise because there just aren't enough homes for sale. I've talked about supply and demand in a lot of this environment, and that's what drives home price appreciation. We think about home prices rising and home sales. We also see plenty of buyers in the market. It's really a matter of buyers can't find a home. They just can't find a home to buy. There's just not enough homes for them. When you see the headlines about softening in home sales at any point right now, it's not because of rising mortgage rates. It's because there aren't enough homes to buy. Buyers who want to buy aren't able to find them right now. I want to layer in the inventory data because I think this really helps paint the picture of what's happened historically and where we're headed as well. When we look at months inventory, and we only have it going back to 2003 and 2004 for this series of data, but we have 5 months of inventory, 4.5 months, 4.8 months. It's very different inventory levels than when we have today. So when we think about these environments where it looks like, 2012, 2013, where there's a little bit of a negative impact on sales, inventory was very different. Home prices are projected to continue rising. Inventory is low. And that's the driver of what's going to propel us forward when we look at what would happen in the market with home price appreciation as well. So what I want to do here is pause for a minute, kind of summarize where we're at as we look at this data. As mortgage rates rose by more than 1%, and we think about a similar environment to where we are right now, home prices continue to appreciate. Negligible impact on home sales. Outside of the housing bubble, of course. And then months inventory was very, very different, and where we are today in months of inventory. Look at the data to formulate your own market opinion. Here's what NAR is saying, quote, while higher short-term interest rates will push up mortgage rates, I expect some of this impact will be mitigated eventually through lower inflation. Thus, I expect that the 30-year fixed mortgage rate to continue to rise, although we aren't likely to see big jumps that occurred over the past few weeks, end quote. This means that inflation is driving this increase in mortgage rates. They are expected to continue to rise, but it won't be at quite a rapid pace as we've seen over the past few weeks. Here's what Freddie Mac is saying, quote, history suggests that when rates rise, there is an initial bump in home prices as many move quickly to buy a home before rates increase further. But after that period, home prices slow. End quote. Freddie Mac analysis shows that 1% increase in mortgage rates results in home price appreciation that is 4 percentage points lower. For instance, a 1% increase in mortgage rates would change home price growth from 11 to 7%. Home price appreciation will slow. Home rates will slow some of the frenzy, but that doesn't mean depreciation in prices. This results in a softening, a deceleration, and that will help slow some of the frenzy as we move forward in this housing market. So let's take a look at the spring market and give you a spring market update. Mike Simonson from Atlas Research said, quote, "We keep watching for it, but there are absolutely no signs of a market slowdown anywhere in the data. If anything, we're seeing the market continue to heat up," end quote. We're still in a very, very busy market. Have been in one for the last couple of years, all through the times we were in COVID, all through last year, and certainly coming into this year. Many were saying, okay, maybe the market's starting to moderate, but we're seeing a very, very busy market. It's busy, spring selling season. If we start to break down by traffic maps, NAR just came up with the most recent buyer and seller traffic maps. Let's start here with the buyer traffic maps, which you see all over the country with a few exceptions. Strong traffic from buyers. The rise in rates is not slowing down buyer traffic across the country. As we head into the spring market, there is very, very strong buyer demand, and the rise in interest rates is not slowing buyers down across the country. If we look at the other side of the coin, seller traffic, very, very weak to very, very slow across the country for sellers. In the middle of the country, above Nebraska and Wyoming, it kind of looks like there's nothing there. If you were asked about seller traffic, there would be nothing there. But across the country, there are very few sellers. And so what happens? Anytime we're in this type of market and we have strong buyer demand, the lack of sellers keeps that upward pressure on prices. If there's any sort of good news relative to sellers and listings, it's in March. Active listings increased in this country for the first time in 6 months. If you go way back to the fall of last year, around September, we started to kind of fall down in active listings, all those being consumed by buyers in the market. And we're starting to see a tick up, very little, but nonetheless a tick up. And the interesting thing is, if you were to look at where we were in October, 382 active listings in the country, according to Realtor.com. Remember, they factor out all the pending listings and things like that. These are just actives. And go back to March of last year, about 471 active listings, just shy of 100,000 active listings short this month as compared to last year. So we need more listings. We know that across the country, but all of this leading to sort of bias towards the upside, meaning forecasters that are looking at the market are saying that we thought it was going to be this amount of activity, but we see it being a little bit more. It's articulated well here by Fortune. They say now more industry insiders are throwing out their previous forecasts and replacing them with more bullish short terms. Indeed, some experts say that 2022 spring housing might go down as one of the most competitive on the record. So now let's look back and review this again. Strong buyer demand, weak seller traffic, all of this leading to a very, very competitive market. But you know, if you look at what's been dominating news cycle, it's the lack of pending home sales. Here is a look compiled by the KCM research team. It's a synopsis of pending home sales over the last several months. Pending home sales have dropped. I'm going to make this argument that pending home sales are down, not because there's lack of demand in the market. We can't sell what we don't have. We simply cannot reach the market potential in real estate because we don't have the number of homes to sell for the number of people that want to buy them. Again, all that keeping upward pressure on prices. But if you look here, upper left-hand corner here, 100 is measured by NAR as a healthy level pending home sales. We came in February at 104.9 pending home sales, which is a healthy market, but down because of the lack of active listings. This is a look at showings that have been measured by showing time, and showings actually exceeded where we were during the pandemic. Look at that. 2020 2020 and 2021 were head-in showings and activity. Those scheduled appointments to see homes, and we were well ahead before the pandemic and well ahead during the pandemic. There's very much a strong demand in the market. It's because of the lack of available homes. All of this keeping that upward pressure on prices. This is the latest look from CoreLogic on price acceleration. Last year, prices seemed to have peaked, but in January, numbers ratcheted up slightly in the amount of appreciation year over year. Still a very competitive market. I think this is also summed up by Craig Lazara from the 𝐭𝐡 report. He said, last fall, we observed that home prices, although continuing to rise quite sharply, began to decelerate. Even that modest deceleration was on pause in January. The 19.2 year-over-year change for January is the largest reading in the 35-year history, end quote. So CoreLogic on the previous slide, this is 𝐭𝐡 report, 19.2 appreciation. Those both in the neighborhood. There is 19.1 and 19.2. Let's call this a lot of appreciation. Well, ahead of historical appreciation. If you read the news or if you just read some of the headlines, you might think pending home sales are down. This market isn't as strong as what it's been. So let's talk about our active listings. Our new listings are greater than active listings. This does a great job. This graphic here shows active listings as compared to new listings going back to August of 2021. So let me break this down for you. The blue are active listings each month, and the green are new listings that are taken during the month. All through the fall and coming into the new year, active listings outpace the new listings until March, where new listings actually outpace the active listings. What does that do? That shows a great sort of picture of what's happening in the real estate market. As soon as something comes to market, it sells. It sells right away. And you can see that here in the March look at the new listings outpacing the active listings in the market. The other slide that I think does a great job of showing where this market is and what all of the issues are single family housing units completed. And this tells a story of why it's so hard to find a home right now, why prices have risen the way they've risen. And the simple answer is right there in the green. For 14 straight years, we've been below the 50-year average in new home builds in the country, going all the way back to the 70s. Back in the 70s and 80s, there were more homes completed in this country than there have been in the last 14 years. The last decade, really, all of that coming out of the fallout of the housing crisis in 2008, builders being hit extremely hard and having to build back slowly their capacity, their ability to bring in new homes to the market. But that lack of new homes coming to market has constricted supply. A lot of people want to buy, driving the prices up, making it hard to find a home. This graphic does a great job of showing that. The other issue I think is going to be a big concern for a lot of consumers this spring is inflation. This is a graphic, you've probably seen this before. This is homeownership as a hedge against inflation. And I've talked about this before. And that's what we want to be able to show. What I really want to show you is that homeownership is a hedge against inflation. This goes way back to the 70s. The blue bar there being the inflation rate, the green bar being home price appreciation. And you see most decades, home price appreciation has outperformed inflation. Maybe neck and neck in the 70s, but a little bit more inflation in the 2000s than what we saw in home price appreciation. But we know there was something going on in the 2000s in the housing crisis. But many of those decades, housing has well outperformed inflation. Something to keep in mind as people are concerned with inflation. Many people are asking themselves, Should I buy right now? Is this the top of the market? This graphic right here shows just what's at stake. In the home price expectation survey, the home price expectation survey is a survey of 100 economists, real estate professionals, market investors, professionals that say, what do you think is going to happen with home prices between here and 2027? And this is the potential growth in the household wealth over the next 5 years, based solely on increased home equity. If you purchased an average priced home, about $360,000 home, in January of this year, what do you stand to lose? Just over $96,000 in equity. That's real money and price appreciation in the coming years. Many people, when you show them, they may think, oh my goodness, I'm concerned about prices. And there are a lot of people that are concerned about prices. But certainly, as experts look at this, they're forecasting home price well into the next 5 years. And so that may be a multiple of that. If you're in a higher price point again, this is about $360,000. This is an example of a home purchase. So this helps those who are wondering, is this the top of the market? Will homes lose value? Well, this is what the experts are saying about home appreciation. For all the people that are waiting on the sideline right now for home prices to go down, this is a look at 7 experts on the average home price appreciation being 6.7%. You see in the green bar right there, there's nobody literally right now forecasting prices to go down. One side, Zelman saying 3%, CoreLogic saying 9.6%, and you see everything in between there. No doubt, this competitive spring market, we will see home price appreciation. I think they'll raise this appreciation number as we go throughout the year, but no doubt we're going to see appreciation in homes this year well above what we've seen in historical years. Thank you for checking out my monthly market report. Don't forget to subscribe to the channel so you don't miss anything.